Welcome. This is Thank God It's Friday. After a very long time, we are welcoming back Mr. Nilesh Shah, the Managing Director at Kotak Asset Management. Always a pleasure to have you here, Mr. Shah. Fitch Ratings recently said that farm loan waivers could actually pose a risk to the fiscal deficit slippage. Plus, you have the Indian trade deficit, which continues to remain higher, and then we also have the RBI, which recently refrained from taking an interest rate cut, citing that they did not want to take any premature action. So, in your opinion, how are the Indian macros shaping up right now?
So one, I'll recommend Fitch to read a report published by Nilkant Mishra on farm loan waiver. According to him, the announced amount and the actual amount, there is always a gap based on past experience and current environment. And the hit to the fiscal deficit will be roughly about 0.2% of GDP over 3 to 4 years. So it's a large number, but it's not something which is going to, destabilize our rating. So I'll recommend Fitch to read what is written by Nilkant Mishra and get itself educated. The second thing, from a macro point of view today, we are in a far better shape than most of our peers as well as our historical performance. Fiscal deficit will be at 3.2% for next year, and hopefully with GST it should come further down. From a current account point of view, with oil prices remaining soft and coming further below 50, it should bode well for this year as well as in the years to come. Inflation, which was our bugbear, is now 2.18% for May, should go below 2 in June. Now that's also quite reasonable. We are experiencing inflation which is at par with developed world. RBI didn't cut interest rates in their June credit policy, but market is expecting them to cut interest rates in August credit policy. If they can achieve that 4% inflation target, which looks like now quite achievable based on current trajectory, then there is obviously scope for interest rates to be cut. So we look at whichever way, fiscal deficit, trade deficit, current account deficit, inflation, we are in a far better shape. Is everything perfect in India? The answer is no. There are two main issues which we need to sort out. One, the NPA. Clearly there is huge build-up of NPAs in the banking system, and we have solved some. We are in the process of solving some, but we need to increase the pace at which this can be solved. The second thing is lack of private sector investment. When clearly investments are falling apart. When I say falling apart, they have declined reasonably. So it's not a matter of grave concern, but it's certainly a matter of concern, because if I want to achieve double-digit growth, current pace of investments will not work. Now, how do we revive investment? One could be bringing down interest rates so that entrepreneurs feel comfortable taking leverage. The second could be increasing the ease of doing business so that they can, set up their projects. The third and the most important thing will be to actually create demand so that the current capacities are utilized properly. So our problem remains around investment revival and NPA resolution. Bearing those two, I think we are in a reasonably good shape.
Right, and the lack of capex, of course, gets reflected in the multi-year low credit growth that we are seeing in the system. And of course, there has been hopes with respect to the pickup in the capital expenditure cycle. But earnings is another issue that we really need to address, because of course the GST impact on earnings, at least in the near term, is widely expected. But there is very little capex, like you said, of fresh capacity creation, which is also being reflected, like we spoke, in the credit growth demand. So what really will drive earnings over the next 2 years? Because if there is still time for that capex cycle to really, move back or start, what will drive earnings?
So today there are sectors like automobile, auto components, chemicals, specialty chemicals, building materials and home improvements, domestic pharma companies, oil marketing companies, where profit growth is coming in at reasonably good pace. Our problems are issues related to leverage business groups which have too much of debt, telecom where there is too much of competition, and PSU banks and corporate focused private banks which are writing down NPAs. Now those NPAs are not created in this quarter. They were accumulated over the years, and because we didn't provide for them in the past, we are providing today. So when you see broad market earnings, it is looking subdued, but in pockets earnings growth is doing well. Now as I mentioned, we have to resolve NPA crisis. NPA can be written off provided we can provide capital to the banks. The government can't give capital to the bank beyond what they are giving because of FRBM constraint. The banks have to become innovative to raise capital. We can follow China model, which used $60 billion of their foreign exchange reserves to recapitalize their banks in 2003. We can follow American model where US Fed provided $700 billion under TARP to buy out subprime loans and student loans and so on and so forth. Or we can create an ingenious Indian model. The banks have investments in, let's say, insurance companies. Now, today they have blocked their capital to run insurance company. Why not liquidate that and offer their retail franchisee as a bank assurance partner? I think that will give them more capital and unblock their blocked capital. So we have to create innovative solutions to provide capital to the bank so that they can write off NPAs. Once they have written off NPAs, they can again restart the credit engine. And obviously we have to ensure that we don't make the same mistakes which we made in the past to build up NPAs. The second thing which is really necessary is the ease of doing business. Compared to global standards, we take little more time in setting up our projects. Many of our NPAs have happened because instead of taking 3 years to complete the project, we have taken 6 years, and in the process, the interest during construction has become substantial portion. So how can we improve ease of doing business on the ground so that my projects can come up as fast as the Delhi Metro Rail project came or Indira Gandhi International Airport in New Delhi came? So how do we create that sincerity of execution across India rather than few pockets where, because of Commonwealth Games pressure, the work was done. I think if we can manage these two things, then my feeling is that slowly and steadily demand will accelerate, and with acceleration of demand, the capital investments will revive.
Absolutely. It's just a question of when in all likelihood, we are going to see all these processes follow, like you said, but it's going to be a gradual process, and that's the reason we're seeing a slow pickup in all of these.
It's a test match, it's not T20. You can't expect every ball to be hit for 4s and a 6. Even if you keep on taking 1-1 run and wait for that loose ball to come, which you can hit for a 4, that's good enough.
Right, so speaking of the test match, and you recently said that if you're underweight equity, you may not want to put a lump sum into the markets right now, but if you're overweight equity, there could be a possibility that you may want to at least partially book out.
Yep.
What are the challenges then? What are the concerns, and why would you advise
Sure.
accordingly?
So before that statement, there was one more caveat, which I said, if you are Kumbh Karna,
yes,
you can put money into equity and go to sleep for 14 years and you won't question NAVs, you won't look at prices.
Right.
Please put 100% of your money into equity and go to sleep. But we all know post-Ramayana, we have never met Kumbh Karna.
Right.
So which is why we are saying that since you can't be Kumbh Karna, follow a disciplined process. If you are underweight equity, it's time to invest in equity. But this is a fair value market. It is not a cheap market like it was in May 2013 or October 2008. So don't put lump sum. Let's say you are at 20% allocation to equity and your desired based on your risk return profile is 50%.
Right.
So that 30% divided into 24 installments, put it over next 12 months. You invested today, you invested after 15 days, but let's say after 30th day markets have corrected. Then you prepone a couple of installments to average yourself into a lower level of market,
right,
lower valuation of the market.
Right. Right.
But if you are overweight equity, you are running leveraged positions, it has worked very well for you. You are in tremendous profit courtesy the super run in the market.
Absolutely.
It's time to take some profit out because this is not the market where you run leverage. This is not the market where you remain overweight because it's fair value market.
Mr. Shah, which or what do you see as some of the biggest global risks right now, which could sort of at least lead to a bump in the kind of rally that the Indian markets have seen, a Fed unwinding of its balance sheet? Is that something that you really think will hurt Indian markets, or the Indian domestic liquidity is way too strong to sort of let it hurt the Indian markets?
So in terms of flows, domestic liquidity is bigger than global liquidity. To sell an IPO, you don't have to go to New York, Hong Kong, Singapore or London. You can sell it selling in Bandra Kurla complex, Lower Parel in Chennai. But in terms of size, the foreigners are far bigger than local institutional investors. Compared to mutual funds, they are 4 times bigger. Compared to mutual fund and insurance put together, they will be twice bigger. So it's the question of size versus flow. The only reason why prices come down is when there is more supply pressure. Now, when will FII sell? They could be selling if they find some other market attractive vis-a-vis India. They could be selling if there is general risk aversion because of some global political event or global, economical event like subprime happened in US in 2008. Or FIIs will sell if they believe that India is not on its course, which they were expecting it to be. Now today, from an economical point of view, I don't see too much of risks. The central banks are unwinding undoubtedly, but they are not going to unwind in a manner which will, derail economies. Right. They have put in enough effort from 2008 onwards to put economies back on track. They are not going to be in a hurry to unwind. They will be very calibrated. Geopolitical, it could be anybody's guess. What will North Korea do? What will China do? What will Qatar and Middle East oil will happen? Who knows? But all these things are today known to the market. So something happening over there is reasonably priced in. But if extraordinary thing happens, then obviously it will get impacted. I think for us, the real worry is, are we on course to deliver up to the expectation of investors? When clearly investors are expecting higher growth, they are expecting higher earnings, they are expecting better governance, and those expectations have come based on our last 3 years of performance. So as long as we are on that growth path of overall economic growth and earnings, I think on a longer period of time, investors will remain bullish India.
Nilesh bhai, in your observation, when it comes to rotation currently, where is the fund going from? What pockets is it going from and what pockets it is going into?
So one thing, what is happening fortunately for market is that it's now reasonably diversified market.
Yes.
On global FII side, you have family offices, multi-family offices, emerging market fund, India dedicated fund, charitable or endowment funds, you have long short funds, you have hedge funds. On the domestic side, you have mutual fund, insurance companies, EPF or new pension scheme money coming. You also have retail and HNI investors. Now, each of these people have different time horizon. Each of these people have different compulsion. Some endowment fund won't invest into, let's say, coal company because they believe coal is dirty. But a retail or HNI might be happy to invest into coal company. Right. So we have now fairly well diversified, fairly well balanced market. And today what we are seeing that for every buyer there is a seller. But if we see institutional flows, they are one going towards ESG concept, which is environmental, social and governance. Right. Retail and HNI probably are not that concerned about ESG, but institutions are definitely, and especially foreign. Second thing which market has done is that they are putting money without looking at market capitalization, but more focused on where they believe earnings growth will be superior. Right. The pedigree of the company, the sector in which they operate, the capitalization which they enjoy, they all are, inconsequential if those companies will not be able to deliver earnings growth. Right. So there is focus on earnings growth, there is focus on governance. I think this is where institutional money is moving on. Retail money also, I believe, is fairly matured. Right. Unlike in the past when markets were on a bull run, we used to see many companies getting lapped up by retail investors through various manipulations. Right. Names will change, SMSs will float out, operators will be involved into it and blah, blah, blah. This time all those activities are bare minimum. Not that they are not there, right, but they are very, very low. So I believe market today is becoming matured enough to go for governance and to go for growth.
Okay, but if I were to bring in your theory of monkey to gorilla to King Kong, Right now, assuming that most of the companies are at the gorilla stage, which are those sectors or subsectors which you feel are likely to become monkeys and others which are likely to become King Kong?
So clearly sectors where we are worried is telecom because of competition, real estate because of the governance related issues, commodities because of the cyclicality. So these are the three sectors where we believe only an exceptional performer will get you rewarded.
Right.
On the other hand, there are certain trends which are like rising tide. As long as you stay in your boat, you will get lifted.
Right.
So one big trend which is emerging is physical savings moving to financial savings.
Yes.
The liquidity is strong in the market, and everyone who can be part of financial ecosystem will get lifted by the rising tide. It could be bank, it could be insurance company, it could be NBFC, it could be microfinance institution, it could be stockbroking company, it could be, you know, intermediation companies like distribution companies. So this is one big trend. The second big trend which is emerging because of lack of private sector investment is the government spending.
Right.
Wherever government is focused on spending, there is enough opportunity there. So road construction, some of the railway equipment supplies, some of the defense contracts, some of the social and urban infrastructure. This is where government's priority seems to be there, and that's where they are spending money, and that's where business is visible.
Right.
The third trend which has happened where for three events or three factors is the formalization of Indian economy. One, Indians are becoming brand conscious.
Yes.
Second, demonetization has adversely impacted trade settlement in cash.
Right.
Not that they are eliminated, but the window has become narrower. And the third is the GST, which is putting huge pressure on informal sector of economy who were competing with formal sector by avoiding tax.
Yes.
Now this is going to create a situation where slowly and steadily business will shift from unorganized sector to organized sector. This trend will be visible in auto components, it will be visible in chemicals and specialty chemicals, it will be visible in building materials and home improvements, it will be visible in domestic pharma companies, textiles, garments. So there are a whole host of sectors where listed companies, which are generally large companies, will benefit because of the shift of market share from smaller companies.
Right.
So these are a couple of trends on which if you build your portfolio, the chances are that monkeys will become gorilla and one of the gorillas will become King Kong.
Right.
On the other hand, if you are invested into telecom, real estate, power, PSU banks,
Yes.
who are writing off their NPAs, there you will have to struggle to find a winner.
Right. Right.
Nilesh bhai, there's been a lot of news flow around banks, and like you said, you like private banks because you think PSU banks are really going to become more like monkeys right now. It's going to be difficult to pick PSU banks. But even within the private banking space, has this pickup in the pace of NPA resolution led to a tilt in your preference for retail versus corporate lenders?
So one, let me correct on PSU bank, they can be a multi-bagger, provided one, the PSU bankers get the same administrative flexibility which they get when they move to private sector banks. Today's most of the private sector banks have people who have their background and origin in PSU banking system. So the banks have manpower, but the environment is curtailing their freedom. Give them the freedom. Second, give them the capital. The NPAs have been accumulated over the years. They need to be write-off. That baggage needs to be removed from the back of PSU bank. Give them the capital, give them the administrative freedom, they'll become multi-bagger. Now today, is there a visibility of those things happening? The answer is no. I mean, we recently saw a comparison of SBI chairwoman's compensation being a meager compared to private sector persons. In such circumstances, how will you attract talent? How will you retain talent? Everyone can't be Mother Teresa who is working only for charity. There are people who work for their family also. They have family responsibility. So give them administrative flexibility, give them appropriate compensation, give them capital. The PSU bankers will become multi-baggers because none of this is factored into today's prices. But till such time that happens, the private sector banks and NBFCs are growing at a much faster pace. They are able to adopt technology, they are able to take faster decisions, their credit standards, especially in retail-focused private banks, is fairly superior, and that gives them the edge on valuation.
So between, when you are talking about within the private banking space, if you're talking about the retail lender versus the corporate lender, is that
I think time has come to start looking at corporate lender, because we believe with this 12 names referred to insolvency board, if those can be resolved, then that will put enough pressure on promoters. Let's remember the fact that in India, companies go into bankruptcy, the promoter family doesn't go. Now, if through some mechanism we can bring promoter wealth also as part of the equation, then the recovery rate on corporate lending will be far more than what is being priced by the market, and hence it's time to carefully look at some of the corporate lenders, but your portfolio should have a balance between retail focused private sector banks, some PSU banks, some corporate focused private banks, some NBFCs, some stockbroking and financial intermediation companies. Combination of this portfolio will create outperformance.
Right, and well, I want to come to the final question from my side. This is a tweet from Mr. Shah, and this is of course with respect to Harvard Marks and the global crisis, but what Nilesh says that in life you'll get half volley or a yorker. On a yorker, save wicket, and on a half volley, hit out of ground. This is of course to do with capital conservation, if I'm not incorrect. Can you explain this to us?
So, you know, Warren Buffett gave a fantastic statement. Rule number 1, don't lose money. Rule number 2, never forget rule number 1.
Right.
That's as simple to make money. Don't make mistakes. Don't lose capital. Conserve capital. That will give you enough opportunity to score run when a half volley comes.
Right.
The cricket or life or stock market, they never give you half volley all the time.
Right.
There will be some bouncer, some yorker, some full pitch, some half volley. It is up to you to, one, stay on the wicket, and second, decide which one to hit. If you try to hit a yorker, yeah, you can hit a yorker for 6 if you are lucky.
If you're lucky.
But how many guys will be so lucky?
Yeah.
So you have to, be a long-term investor. You have to be you have to be disciplined in terms of your asset allocation. You have to pick up broader trends and then stay invested for it over a period of time. My favorite example has been stock of HDFC. Everyone knows it's a great company.
Yes.
If I remember correctly, from 1991 to 2015, the quarterly high-low difference between the HDFC's highs and lows were about 40% plus. Now, technically, one could have always bought HDFC at quarterly low, sold at quarterly high, and made 40% return.
Yes.
How many guys have done it? But there are so many people who have enjoyed HDFC's run of almost 90,000% from 1991 to 2016.
Right.
There are guys who would have made 10,000%, there are guys who would have made 50,000%, and there may be some lucky who would have made 90,000%.
Right.
So don't try to trade, try to pick up the trend and stay invested. I think that's the way to create wealth.
Right. Well, Nilesh Shah, it was a pleasure speaking with you like always. Thank you very much for joining.
Thank you.